stock of the day, AGL, has had a bumper report coming out. A jump in half-year profits by 359%. Told investors it expects to post annual returns at the top end of its guidance. Increase in half-year profit came despite the company missing revenue. So profit up 359%, revenue down 20%. So, and also the company saying generation costs had fallen 28.6%, interim dividend 26 cents a share. So profits quadrupling, costs down and revenue down seems to suggest, Michael Gable, that margins have really blown out.
Yeah, and they're doing well, but they're one of those companies like the supermarkets and the banks that when you see them doing well, you wonder if they'll get a knock on the door from the government saying, "Hang on, there's a cost of living crisis, and you guys are doing pretty well there." So,
yep, which would be fair enough in this, wouldn't it?
Yeah. Look, it's not one that I'd normally recommend, and I'm not recommending it now either. I mean, it has been, unfortunately, over the long term, a bit of a capital destroyer. Unfortunately, a lot of investors hold this for the dividend. But you lose more than the dividend on the capital. Share price performance longer term has been very poor. With these utilities, I guess what you would be looking for would be, like a Transurban type business where the income, the earning stream's pretty reliable year on year. Whereas obviously with AGL, it has been a bit all over the place. So, you're buying into a utility. The dividend's only a few percent. I guess it's gone up today. In a high interest rate environment, you could get a better return in the bank. Obviously, a risk-free return with your money in the bank. So, look, great result for the moment. Share price is up 12%. Maybe it can squeeze a bit more out of it on the upside, but just that variability in earnings is not great for this type of investment. And then you've got that government risk that they might do something with the prices and affect their margins in the future.
Energy costs have been one of the big drivers in inflation over the last 12 to 18 months. And the energy retailers have said, look, it's the cost of imports, it's the cost of generating, all of that sort of thing. But coal prices have crashed, gas prices are well down, and now they're saying they've had a 28% drop in generation costs. So no wonder sort of AGL customers have been knocking on the door and saying, well, why haven't you been passing all of that on to us?
Yeah, I mean, any other business, you'd be banking the profit and continuing to do so. Whereas a business like AGL, that will attract a bit of scrutiny, and they'd be expecting to lower the prices along the way, and therefore the margins and profitability will be under pressure. So, look, we'll have to see what happens, but I just think that's a key risk from here. And if you've been in it and you've seen a 12% jump in the share price today, maybe try to squeeze a bit more out of it over the next few days as all the analysts upgrade their numbers. But then you might be better off moving on to something that's
so you've got to sell on
risk. Yeah, I'd have a sell on it at some point. I'd try to get a little bit more out of it over the next few days, and then I'd be looking to move on.
Okay, Kevin.
Yes, I have to agree with Michael. Obviously, in Team Invest, it wouldn't be one of ours because of what Michael says about the variability. It's made losses in the recent past. So that 300%, whatever it was, sounds good, but it's coming off of recent losses. So, you would hope they'd do something. It's the problem of a business, being in a business where you're providing a necessary service, necessary to society. Whenever you start making good profits, as Michael says, society starts looking at you and governments start looking at you and saying, hey, you're providing a necessary service, you need to wind back your profits a bit, somehow. So that's one of the problems of a business like that. The risks in this business too, with the energy transition going forward, they're closing down coal-fired generation. Generation is changing. We now have more generation from solar rooftops than coal. So they have to negotiate that moving landscape, if you like, as well, which they may well do it very well. But it does present some risks, as well as, I think, the risks that Michael said. So from our point of view, it wouldn't be one that I don't think many of our members would be interested in. We did a study a little while ago of some of our wealth winners, and there's that issue of growth versus dividends.
Yep.
And as Michael says, some see this as a dividend stock. What we found was that if you hold businesses for the long term, because the dividends from the so-called growth stocks increase with the growth of the business, in a relatively short time, a few years, quite often the dividends actually outgrow the dividends from so-called dividend stocks. So, I'd say this is not one that many of our members.
All right. So, no from Team Invest.